I hear you. I hear you, Patriot Nation. You want to invest in real estate, and maybe you already have, or maybe you want to start. Either way, this video is going to cover the 4 best loans to establish the acquiring of residential real estate through financing. Whether you've owned a home before, an investment property, or you're looking to buy, or maybe you even have a big portfolio already. Doesn't matter. We're going to cover some ground that you haven't seen before, especially the last example I'm going to give you of the loan type. If for all you savvy guys that already have a number of homes under your belt, or you've just got a very strong balance sheet, you're definitely going to want to see this last loan because it's rather mind-blowing. So as always, let's kick this rodeo off right now. Hi, folks. I'm Kevin Fagan. I'm the Mortgage Patriot on your side here in Central Texas, nestled in the hill country above San Antonio, serving proud Texans and helping out great folks all across this great country. So before I get into the content, if you would hit the like and subscribe button below, it really helps me build more content for you. And as you probably, a lot of you have already seen, I've got some good content on my YouTube channel with helping you either purchase a home for your primary or your investment property, like in this video is going to talk about, or just refinancing a property and trying to save some money on the interest rate. So it can help you either way. So let's get into this content right now. There's lots of ways now for investors to acquire residential real estate via financing techniques. I've shown you a few of those on prior videos. I've got one on VA loans, using a VA loan to acquire investment properties. And I've got one on FHA loans. Both of those strategies involve becoming the primary owner of the home initially. In other words, you're going to move into that home initially, and then after a year or so, rinse and repeat the strategy, so to speak, and you leave behind the home that you were previously in as a rental, and you move forward with a new purchase of a new primary home. That's not the strategy here. What we're talking about here is buying a house just straight up for a rental property. You already own your home right now, or maybe you don't, but usually you own your home right now. You're living in it, obviously, and you want to acquire more homes, but you don't want to have to move and leave behind an existing home that you turn into a rental. You want to stay where you are and just start accumulating rental properties. Just that simple. So here we're going to talk about the 4 best loans to do that. So let's start right now. I'm going to talk about traditional financing. And by that, I'm going to distinguish that from non-traditional financing. And that would be hard money loans, private money loans, and creative financing. And I have access to and I understand all those concepts. I can do different videos later on those subjects. But let's talk about just traditional loans, meaning loans that are typically 10, 15, 20, 30-year programs that meet certain needs. And there's 4 categories. The first one is just a conventional investor loan. The second one is bank statement loans. The third one is DSCR loans. And the 4th type of loan would be what I'm calling the ultimate loan. I'll explain all 4 of these. I'll give you all the requirements and guidelines. And then because they fit different needs, and we're going to go over each one, like I said, and you'll know by the end what's best for you. Let's talk about the conventional loan first, because it is the one that you would want to acquire and use if you can, because it's the lowest interest rate out of all these options we're going to talk about. And it also probably would be the easiest in terms of qualifying. Let's look at those qualifying natures right now. If you are a W-2 worker, you receive a W-2 paycheck, or even if you're self-employed, but you have tax returns. So those are the eligibility requirements. You have to have either W-2 salary or hourly wage proved with pay stubs, or you have to have, in the case of self-employed or 1099, you need to have tax returns. If you have those items and you have enough income, then that's one aspect of the qualifying. The second one would be credit scores. Your credit scores can need to be a little higher than a primary purchase. They need to be in the neighborhood of usually 660 is usually a starting place a lot of lenders will require. So 660 and higher on the FICO scores. What about debt to income ratio? Your debt to income ratio on a conventional investor loan is going to be about 50%. What is the debt to income ratio? That's the amount of debt that you have across the board. In this case, your primary home monthly payment, your new investment property monthly payment, and your other debts like your revolving cards, your installment loans, your student loans, so forth. All those 3 categories of debts into your income on a monthly basis, that ratio cannot exceed 50%. So relatively restricted there. Now, a lot of people ask, hey, I'm investing in this property that's going to pay a certain amount of rent. Do I get credit for that rent? The answer is yes, but just not dollar for dollar. So let's say that the rental amount that you're going to receive based on an appraiser going out to the property and doing an investment appraisal, they're going to say, hey, this neighborhood usually gets about a $2,000 rent. And so therefore, the lender is going to take a factor of that. Usually it's 75%. So you can count on about 75% of 2,000, in this case, 1,500, would be added to your income level to go into that ratio of debt to income. Hopefully that makes sense to you. So you do get applied rental income, just not a full dollar for dollar. So let's talk about, lastly, reserves. What are reserves? Reserves are the amount of money you need to have left over after you have the transaction closed. The lenders don't want to see that they're taking your last dime. So they tell you you have to have 2 months reserves, they might say, 3 months reserves, up to 6 months reserves. And again, what are reserves? It is a multiple of your mortgage payment for the investment property. So if your investment properties, PITI, principal, interest, taxes, and interest for your payment, your total payment is, say, $2,000, then a multiple of that would be 2 months would be 2 times 2,000. So you would need to have $4,000 left over in your bank account or your investment accounts after the transaction is finished. If they require 6 months, you need 6 times 2. You need $12,000 left over. Depends on your FICOs and other factors. Is the lender's going to tell you how many months of reserves you need to have left over. And lastly, the down payment. We talked about the down payment. Typically, an industry standard on a conventional loan is 20% down. Now, depending on your credit score, I might be able to get you 15, but it's 20% typically across the board. So on a $250,000 house, we're talking about $50,000 coming out of pocket, not including closing costs. So it's a pretty good bite there. So anything that we can do to get down that ratio, maybe to 15%, of course, would help you. But let's get into now the other alternatives, which would be the bank statement loan. So what are the bank statement loans? They're pretty much as described. They're going to only use your bank statements to try to qualify for the loan, as opposed to the conventional loan where you can see the W-2 pay stub that you have, or you can see the tax returns you have. With the case of bank statement loans, you would use that because you don't get W-2s because you're self-employed, and your tax returns don't reflect properly what your real cash flow is because you're optimizing all your expenses to minimize your tax returns. Lenders understand that. You might have $10,000 flowing through your bank account from your business or from all your side operations, but your tax returns only reflect maybe $5,000 per month. So that's not going to get you very far, right? So you can just apply with 12 months bank statements, or in some cases 24 months bank statements. Either way, that's the bank statement loan. It's a much higher interest rate than the conventional loan. And let's go through some of the other qualifications. The FICO scores are going to be 660 or better, maybe 680 or even better. So slightly higher FICO requirements than the conventional loan. The reserve factor is going to be roughly the same, about 2 months to 6 months, like we talked about on the conventional side. And lastly, the down payment is going to be 20%. I can't think of anything that would be 15%. So it's going to be at least 20, sometimes even 25% for a bank statement loan. So the time that you would want to use a bank statement loan is because you do not have tax returns that can support the level of income that you need. Let's talk about DSCR loans, because that'll probably be a better alternative than a bank statement loan in a lot of ways. Let's talk about the third investor loan, and that is the DSCR loan. What is a DSCR loan? It's debt service coverage ratio loan. And it's very popular because it is simplified in that the application doesn't even ask for your employment. The lender is going to be looking solely on the basis of the rental inflow versus your debt service on that property. If you have a $2,000 rent coming in, for example, and your debt service, your principal, interest, taxes, and insurance on the mortgage note for the investment property is $2,000, then your debt service ratio is 1-to-1. 2,000 over 2,000 equals 1. So they look at that ratio. That ratio needs to be at least 1 or higher. So in other words, you need to show a positive cash flow on your property that you're investing in to obtain the DSCR loan. It's great because investors can just stack these loans without regard to their income. The lender is not looking at your income. They're only going to look at the cash flow on the property. So as long as you are maintaining a good debt to income ratio aside from these properties, you can buy 5, 10 properties, as long as they're all cash flowing, you can just keep acquiring these properties because, again, they're just looking at the cash flow per that DSCR ratio. So it's a heck of a deal. And that's why most of the times, if you can't qualify for that conventional loan, you're skipping the bank statement loan altogether. And you're just going straight to the DSCR loan. The rates are going to be roughly the same as the bank statement loan. The credit scores need to be about 680 or better. Your reserves need to be about 3 months or better. And again, the down payment is going to be at least 20%. And depending on where that debt ratio falls, it might even be 25%. Most of those qualifications are roughly equivalent to the bank statement loan. But again, it's a little bit better product maybe because you can just acquire more and more of them without regard to your income. Let's talk about this last loan because it's the most fun and absolutely the most dynamic and most impactful to your finances if you can qualify for it. I call it the ultimate loan. Why? Because there's only about 4 institutions across all the thousands of lenders across the country that even offer it. They call it different names in-house. I call it the ultimate loan just to give it a name. And why is it the ultimate loan? Because it is a HELOC, a line of credit established on your investment property. Very rare opportunity. And what does that actually mean? Well, relative to a traditional loan, a line of credit, as you probably know, can be paid down and reborrowed against. So if you have a $200,000 ultimate loan against a rental property that you purchased, and you paid it down now over the course of a year to 150, you now have immediate liquidity that you can write a check on for $50,000 to get back to that $200,000 loan limit. So you can write a $50,000 check in this example and put another down payment on another home. Watch this video, please, because I go into detail how to use a line of credit to acquire investment properties. Look at this video, learn it, love it, live it, and you're going to be amazed because you're going to come back and say, hey, do I qualify for the ultimate loan because this is what I need? So let's talk about some of those qualifications now, and they're more stringent than the others by far. You really need to be an A+ borrower. Most people cannot be eligible for it. So what are they? FICO scores, 700 to 720 or better, depending on area and certain factors, but at least a 700, most of the time a 720. So FICO scores are pretty high in the A+ category. Debt to income ratio. Your debt to income ratio is very small. It's only about a 43% debt to income ratio. We talked about the 50% debt to income ratio on the prior loans, conventional and the bank statement and the DSCR. But with ultimate loan, only about 44% of all your debts relative to your income. That's pretty tough. Your reserve level, they're going to be asking for about 6 months reserves. It's not the 2 to 6 months. It's going to be started off at 6 months reserves. After you close the loan, you still have to have a lot of money in the bank account afterwards. And lastly, your down payment is going to be higher as well. It's going to be start off at 25% for a purchase. You can do a refinance if you have an investment property that you have right now, and it's free and clear. Let's say it's worth $300,000. Then you can get a cash out ultimate loan. That would be a 30% equity deal. In other words, 70% of the loan. So it'd be 70% of a $300,000 home. That would be $210,000 that you could access with the ultimate loan if you have a free and clear property worth $300,000. So as you can see, all the different areas are a little bit tougher to get into in the ultimate loan. But watch that video, as I mentioned earlier, and come back to me in the comments section or text me, call me at 210-317-6514. Kevin Fagan, I'm the Mortgage Patriot. Let's find out which one of these categories, the conventional, the bank statement, the DSCR, or the ultimate loan would be best for you in terms of acquiring rental properties. So make it a great one, folks. Bye-bye.